Hi, everyone. Welcome to the Money Coach. This is Damien, the financial guru here. Um, this is your show for your go-to cheat sheet for all things real estate and finance. Here today with my co-hosts, Tara and Robert, and we are going to be diving into the world of mortgage loans today. There's a lot that's going to get covered today, but it's going to be okay. We have the two experts here to cover it with us. We're going to be talking about everything from traditional conventional loans to government-backed options like FHA, VA, and USDA loans. We'll break down the pros and cons of each, guide you through all of the eligibility requirements, and kind of help you understand a bit better which loan product might be the best fit for your unique situation. So let's get started on seeing which is the perfect loan for you guys. But before we do that, Tara, can you go ahead and take it away with our market report, please?
Yeah, sure. Thanks, Damien. Not a whole lot has changed in the last couple of weeks. We're still waiting to see what the Fed does with the rates on September 18th. But actually, in the past week, the rates have gone down a little bit, about 1/4%. And we're also expecting on September 18th for the Fed to cut the rates even more, maybe another 1/4%, maybe even up to 0.5%. So if you got in above a 5% interest rate, it's a really good time to refinance right now because you never know what's going to actually happen with the rates on September 18th. But if you did not get in a rate above that, let's wait and see what the Fed does on September 18th. We'll definitely come back with a new update next week.
And just to even capitalize on that, we have these great tools that we work with here that we can see for the past 3 months what rates look like, and this is what's given us our indication on why, how Tara mentioned, if you want to wait until September 18th. But also know that if you have everything in line right now, have the house in order, and the iron is hot to strike, call us up. We'll help you out with that. So sorry about that. I just wanted to interject, what we have here. And and this is also a great tool. We can even find out, hey, for your credit score, we have that down here where we can just even toggle over and see, okay, what are the rates for these types of credit scores? We're going to dig a little bit more into that in a bit.
Yeah, thanks, Robert. So yeah, as you guys can see, the rates have gone down quite a bit in the past few months. Definitely a great time to consider buying if you haven't already. And if, again, or refinancing, and if you are above a 5%, definitely talk to us about refinancing today.
Thank you, Robert, for that very good and useful tool, letting everybody see how rates have been dropping. Tara, useful information on the market report as always. Now, let's go ahead and start to get into the meat and potato of today's show. We're going to begin speaking about conventional mortgages. Tara's going to go ahead and lead this portion off, so go ahead and take it away, T.
Sure, yeah. So a conventional mortgage it's a type of mortgage that is not insured by the government, but it adheres to guidelines backed by government-sponsored enterprises like Fannie Mae and Freddie Mac. And if you qualify or you're eligible for a conventional loan, it's really beneficial to home buyers who do meet those requirements because they typically have lower fees because they don't have those government fees associated with them, and they have more competitive rates. So with conventional mortgages, you're going to see the lowest rates if you can go that route. So let's get into the eligibility requirements for a conventional mortgage. You have to have a minimum credit score of 620. Some lenders might have stricter requirements, but generally the lowest is a 620, and a down payment of 5% of the purchase price. There are some lenders that will do as low as 3% if you are a first-time home buyer. And 3%, that's a really good option. So if you're a first-time home buyer and you meet those credit score requirements, definitely consider getting a conventional loan. We also want to talk about debt to income ratio. For conventional, you're going to need a 43% debt to income ratio.
Whoa. Hold on really quick, T. Hate to interrupt you. Just so everybody knows, we should probably tell everybody what the debt to income ratio is or what's behind that. So is it all right if I just go on the financial guru kind of soapbox and then hand it right back over to you?
Yeah, sure.
All right, fantastic. So everybody, your debt to income ratio is basically a breakdown of what you make versus the total amount of expenses that you have. just a quick example, let's say you make $1,000 a month and all your bills, rent, groceries, utilities, it comes to $480. So that would essentially mean that your debt to income ratio would be 48% because you're dividing your expenses by your income. That's all that is. It's nothing super fancy or just crazy jargon. Just wanted to go ahead and interject right there, but that's a quick explanation of the debt to income ratio. Tara, please take it away.
That's awesome. Thanks, Damien. Yeah, so for conventional, you're going to need a 48% DTI or less, typically a 5% down payment. Unless you're a first-time home buyer, you can do 3% down, and you're going to need a 620 credit score. If you can meet those requirements, it's definitely the best way to go because you're going to have competitive rates and the lowest fees when it comes to getting a loan. And that's the basics of a conventional loan. And if people want to know more about it, they can always contact us. We're the experts here. We can deep dive into that if that's the right loan for them.
So I'm going to go ahead and, I'll let you know about FHA mortgages. These ones are very interesting. To qualify them, you'll need to meet several, requirements. But like anything else, for high risk, you got to get a good reward. So these are those requirements. They're actually not too bad if you really think about it. Credit score minimum of 580. And 580, that's not a great credit score, but hey, as those credit tips that we spoke about in the last video, that will improve that, but that's usually required for at least a 3.5% down payment. That right there, is the standard with FHA mortgages. That's the loan limit, percentages. And then if you have below that 580, you're going to need at least 10%, so you're going to need a little bit more. So, this is where you're going to be able to have to educate yourself further, and that's what we're here to do, is help you with that and find out what is needed to get that credit score better so you can come in with the right down payment for the house you're in your price range. So speaking of down payment, that's going to be the second thing. And then as mentioned, it's going to have to be a 3.5% is the typical standard down payment, and then as mentioned, 10% if your credit score is below that 580 marker. So, and really, if it's below a 500, you're not going to get approved for a mortgage. Just bottom line, those 2008 days long surpassed that. So then the next thing is it has to be your primary residence, meaning it can't be an investment property. You can't say, hey, I'm going to Airbnb it. It has to be the home you're going to live in, because the FHA, that's a government entity, where they're backed by, and we'll go in another video, they're backed by something else that's an oversight. So they want to make sure that the money that they're lending for you to get that home, that it's actually yours, so making sure that that is your home, and they will check. So also is the debt to income ratio. As Damien mentioned before, it's a certain percentage of your income to debts, and that has to be at least at a 43%. And the underwriters, they're pretty stringent upon it. They want to make sure that everything is copacetic. So, those are some of the requirements that you're going to have to meet to get an FHA loan. These are particularly useful for first-time home buyers because they necessarily don't have 20% down from a previous sale of a home, a move-up buyer situation where you're going to sell your primary home, get a larger home. And a lot of times, just to make that bridge, that connection, that's what these little FHA loans, hey, you're going to have a starter home, and then eventually it's going to jump to a larger home. That's going to be these. Then there's also a different category. There's VA mortgages, and these are for those veterans out there. Oh yeah,
sorry,
go ahead.
I just wanted to interrupt you real quick because that was a really great recap on FHA mortgages, but I wanted to just recap the difference between conventional and FHA really quick so that people understand that. So you're going to have the same debt to income ratio on conventional and FHA, 43%. So that's pretty standard. That's actually like pretty high, you can have a lot of debt in that situation. The biggest difference between the two is FHA requires a way lower credit score of 580, and the down payment is going to be a 3.5%, whether or not you're a first-time home buyer for FHA. So if you're looking for a low down payment and you've got a low credit score, FHA is going to be the best option. And it's a government loan, so there might be some fees associated with it versus conventional. If you've got a higher credit score and you can put a little bit more down, then you're going to have less fees and maybe a better rate. And sorry to interrupt you. Just wanted to
No,
recap.
no, and you know what? And that's a great segment there too, because you know what, and something I did forget, to mention, and I want to make sure, and I have it in my notes here, so it's going to be at the bottom. But it was to make sure that all of these government-backed loans that I'm going to be going over, the FHA, the VA, a USDA loan, those all have what are called, upfront fees, or MIP, mortgage insurance premium. We'll go over that in another video to explain that. It's going to be a short video, but obviously that's an important feature. Upfront mortgage insurance premium is something that's a one-time payment. And with some of these, it can be 0%, depending on if you qualify. And that's going to be those VA loans. So VA loans, those can be a 0 down payment for those that qualify. And that's basically your eligibility. So, these are for service members and some spouses if they are surviving spouses, but you kind of have to show a lot of paperwork with that. We'll go over that right now with some active duty. The veteran is generally 90 days of service during wartime or 180 during just peacetime. So if there's no active war happening, obviously it's 90 days so they can buy a home. And let's be honest, that's going to be the last thing on their mind. So, but there's going to be National Guard reserves for 6 years and service of at least 90 days prior. So you have to, once you're at that 90-day mark, even if you're, reserve and you're inside of it, hey, you're available for a VA home loan. And that's if you have that eligibility where you can take advantage of that 0% down payment. And it's amazing, you can finance that funding fee because that's what it's considered for a VA loan. A funding fee, normally that MIP that's paid at the front, and it's our premium mortgage insurance. I'm so sorry, but it's something that that can be added to the loan where you don't have to pay it right at that time. Then that's going to have you're going to have to make sure you're going to get your credit of eligibility or certificate of eligibility. Excuse me. You'll need this to verify that you are a service veteran. Then we have the credit and income. That is a pretty standard 620 you're going to need a minimum of, so you can make sure you can get that loan. Then you're going to have that credit to income, which is, we just spoke about that. We're going to have, again, all of these have to be primary residence. It's like any type of government loan, they want to make sure that that's your home, not an investment property. So, even if you move out of it, they want to make sure, hey, we have to restructure this loan. It's just the ethics that they have to withhold. So the property requirement. The property must meet certain minimum standards by an appraiser. And these appraisers, they have to be certified with the Veterans Association. So it's making sure that they're giving you a good, fair assessment of that property. So the lender can say, hey, I deem this is a good, tangible asset to give you a loan on. Then I did mention the no down payment. So that's always something, it's huge. Service members have already done so much for us. This is the minimum what our government can offer back is saying, hey, we're going to be able to say 0 down payment for those that qualify. And that eligibility, that's certificate of eligibility, we have a website that we can look that up for you and then basically walk you through the steps to be able to make sure you're eligible. Last but not least, it's the USDA loan. This is particularly, close to my heart just because this was my first home loan. It was a USDA home loan, and this is a great product because 0% down payment, and it's no minimum credit score. So these have certain requirements as well. Location, they want to make sure that, hey, if it's in a rural area where it's not as developed, hey, yeah, you're going to have to drive, 30, 40 minutes away to a major city, but it's a home of your own. So, that's the location, it has to meet that certain particulars. Then we have, again, primary residence. Like I mentioned with the other two, has to be your primary resident, not an investment property. Then the income limits. Your household income must meet or be below 150% of the median household income for that area. And with that, I'm
Hold
going to
on,
hand it
hold
to
on, Robert.
Damien.
Yeah. I hate to put the brakes on there really quick. So when you say a median income, now remember, folks, Robert is not referring to an average. He is referring to the smack dab number that's in the middle for that area. So just to talk to some numbers really quick, if it's 115% of the requirement is needed, or your household income must be at or of 115%, let's say you made $60,000, just multiply 60,000 by 1.15. The answer to that, folks, is $69,000. That $69,000, that is what your household income must be in that area to qualify for a USDA loan. So sorry to interrupt, Robert. Just wanted to go ahead and make sure we don't lose everybody in the minutia. I know you guys, everybody we get really into talking about this stuff. I just wanted to make sure that everybody knows that. But I'm going to go right back to Robert to go ahead and finish up talking about the USDA types of loans.
No need. No, thank you for explaining that. That was an excellent example. So now back to, the last requirement that's really needed, that is really looked at is the credit score, like the rest of them. But this one is a little bit different. There's no minimum credit score required, but there is that but. It's going to be funded by a lender in the secondary market, which we'll be able to explain to you, what if we have a consultation to you, what that entails of. But they're going to want a minimum of 460. So there's that requirement. And plus, again, I'm always going to refer back to the healthier the credit score, the heavier lifting your credit can do. What I mean by that is how many zeros that credit score can lift, depending on the loan limit. So, the healthier the credit score, the more it can lift. So just think of it as a power lifter. So now, in all the USDA loans, they're designed for moderately to low income households. And, like I said, as a single income family with a wife in college at the time, it was a perfect loan for me. And here's something else that, I didn't have on my notes. That's a little caveat. If you sign within the first 3 days of the month, so on the first, second, or third, then you're eligible for a grant where they'll give you money back. And basically when you do signing, you'll get some money back from your earnest deposit later on that day. So it's a beautiful program, so we have to make sure that you fit in these requirements to be eligible for this type of program. And again, the most important, it's the area. It can't just be, hey, you live in, Austin and you want to be right there in the city. You're not going to get a USDA home loan. So, this is for a little bit more of the rural areas where you're further out from the cities and areas that they hopefully want to develop. With that, I'll yield it over because we have 2 more products that we can go over. That I won't spoil it.
No, that was a great recap. Thanks, Robert. So we went over conventional, which is a non-government loan. And then Robert explained our government loans, which is your VA, USDA, and FHA. And so those are kind of the big major types of loan products out there. But I want to talk a little bit about this is going to be for the people that are interested in investing rather than looking at their first home, maybe not as new to this as some other people are. And it's a DSCR loan. And that's going to fall under the category of a conventional loan. But it's an offer that makes it a little easier to get an investment property under this DSCR loan, it stands for debt service credit ratio. And what it means is the lender is going to evaluate your eligibility and your ability to repay the loan based on the rental income that the property is expected to generate. So this is calculating the income you're expected to receive rather than the income you already have. So it's going to lower your debt to income ratio, making you eligible to buy that investment property. So there is a calculation for that, and it's net operating income divided by total service debt, and that's going to be your DSCR rate. Your DSCR has to be at least a 1.2, meaning the property should generate 20% more income than the loan payments. And there are going to be some higher requirements to be eligible for this type of loan, because you're trying to get an investment property, right? You're not going to live in this home. It's not going to be your primary residence. So you're going to need a credit score of 620 is the lowest. Usually they want around a 700. From 620 to a 700 minimum credit score. It varies by lender. And generally a down payment for an investment property like this is going to be 20% down. So you're going to need 20% down payment of the property's value. However, if you are looking at your second home to turn into an investment property, and you're already living in your primary home, you can use equity from that home to help you pay for the down payment in your investment property. So a debt service credit ratio loan is just going to help people qualify based off of their income by calculating future expected income to generate from that rental property. And another loan product that I want to discuss is specific to our Texas people. And this is going to fall under the category of an FHA loan. It's a TSHAC loan, which is offered by the Texas State Affordable Housing Corporation. And they're a nonprofit organization that is dedicated to increasing access to affordable housing in Texas. So they're offering two types of assistance right now to help people get into homes. One of those being a down payment assistance program, where they're offering up to 5% down payment that can either go towards your closing cost or towards your down payment to help you afford getting into your home up front. So like, let's say you wanted to get in on that FHA loan and you only need a 3.5% down for it, but you qualify for a 5% grant, you can use 3.5% of that for the down payment and the remainder of it to cover your closing costs. So you can get into a home for little to no money down with this kind of offer that they're giving in Texas right now, because it's just free grant money. So definitely, if you live in Texas, it's worth looking into to see if you're eligible. And we do have an eligibility lookup tool that we'll put in the show notes. And they're also offering another type of credit called mortgage credit certificates, which is a tax credit of up to $2,000 per year based on the percentage of mortgage interest that you pay. So this is basically going to increase your tax return at the end of the year because you're a homeowner. And so that's something else you can look into. And you have to be a new homeowner or not have lived in a home for the past 3 years. So TSHAC is offering awesome assistance right now to our Texas people. So if you're in Texas, please call us. We would love to help you. And for the TSHAC loan, you need a minimum credit score of 620 because it is a conventional loan. And yeah, like I said, we'll put the eligibility tool in the show notes as well. And that's pretty much all of the loan programs we wanted to discuss with you guys today. And if you want to know further detail about any of them, we're here to help. You can call us, email us, and we'd love to discuss anything that would be best for your financial situation.
Wow. Thank you, Tara. Thank you, Robert. Lots and lots of information, folks. Starting from the conventional loans, getting down to the government-backed stuff, the FHA, the VAs, the USDAs that Robert went ahead and covered, and then Tara gone ahead, closing it up with the DSCR and the TSHAC for our Texas folks. Whew. All right. With that said, remember, you always have more success and you save more money when you what? When you work with a mortgage broker, folks. When you work with a mortgage broker. So
That's us.
Loan and Key. That would be us. If you ever have any questions, any needs, we are here. But I did want to say a huge thank you to my co-hosts because they did a lot of the heavy lifting on today's episode. But it was a really good, informative episode. And more than anything, we hope that all of you got something out of that. This isn't for us. This is for you. So with that said, I just wanted to say thank you, Robert. Thank you, Tara. And this is the financial guru, Damien, signing out and saying stay tuned for next week's episode. See you, folks.
Take care.
Thank you. Bye.